Hey everybody, my name's AJ. Welcome to the Wealthy Idiot Show. Today I want to talk about whole life insurance and infinite banking specifically. It's a hot topic and people want to know the details around this. I've been looking into it for a while and I had a hard time wrapping my brain around what it is that you're doing with the whole life insurance policy and what infinite banking actually means. So I thought what we could do to start this topic off was bring in somebody who can answer those questions. And so today I have Mark. Hey, Mark, how's it going?
I'm doing great. How are you, AJ?
All right, doing great. Thank you. So go ahead and tell us a little bit about yourself and like how long you've been in insurance, how you got into insurance.
Okay. Um, well, yeah, I am or have been born in San Francisco, so I'm definitely a Bay Area native. Shout out to the championship Warriors. Uh, but yeah, I've been in Bay Area all my life. But I can't say my second home is Chicago. That's where my all of my family's from. If it wasn't for my parents coming out here when they did, I definitely would have been born in Chicago. So,
Mm,
but that's my second home. Um, I mean, I'm 34. I honestly love what I do as a career, and that's not just me trying to, sell myself. I honestly love what I do, being in the insurance industry. So I know there's not many people can say that. So, um, along with that, I have a dog, a wife. I love some good food, whether it's Mexican, Mediterranean, or anything else that has some true flavor. So I'm pretty simple.
nice. Classic
um,
Bay Areaite right there.
yeah, exactly. As far as my experience goes, I've been in the insurance industry for about 14 years total. Um, I worked with State Farm as a captive agent for about that 14-year period, and now I transitioned over to Farmers as a broker since the beginning of 2022. So, kind of changing lanes, but it's a better fit for me because I have a broader scope on being able to broker out um, policies if for some reason we can't do it with one company. So definitely a good change of pace.
Gotcha. So what got
Uh,
you into insurance specifically? Like why this field?
um, well, the funny short story is when I was 20 years old. I had a cousin that dated a girl that worked at a State Farm office, and at the time I was going to school at San Francisco State, and we would always go to that office to go pick her up. And one day I went in just to grab her and noticed there was seven beautiful women there, and I literally was like, "Hey, you guys have any openings?" You know, I mean,
That's
I
amazing.
never thought of doing insurance. I mean, my dad has a background in real estate, so that was always kind of put in the forefront. But that's literally why I walked into that office, and she said, "Yeah, we actually need somebody to kind of do some marketing activities, and if you're willing to do it, come in and do it, and we'll see what happens." And I mean, it literally started there, and I just grew from doing marketing to getting my licenses and started doing more policies in the scope of auto insurance and home and business and life insurance. So that's that's what got me in the ladies.
There's a quote somewhere that talks about how almost every great thing man does is done for a woman. Something like that. I'm probably really misquoting that, but that sounds about right.
Yeah, it sounds about right.
All right.
But for sure, I mean that's why I got in there. And I'll say, as far as the life insurance side of things, I mean my own personal backstory about it. Um, I went through multiple family members that passed and
Mm,
did the whole let's create a GoFundMe and try to get some help and push that out on the internet so people can donate to you know paying for funeral costs. And um, I went through it so many times with my family members where, and this is before I got my license, of course.
mm.
I went through it so many times that I was like, there has to be a easier way. I mean, because it sucks to have somebody pass and then you're asking people for money, and not everyone, death always comes at a bad time. So not everyone is just going to have thousands of dollars to give you. So after going through that so many times and multiple, funerals that just I thought wasn't the right way to send somebody out. I decided that I was like, okay, I'm in insurance, so why not look into getting a license in life protection and see if I could help people. So we're not being irresponsible and putting this on our loved ones after we leave. So that's really what got me into it.
For sure. Yeah, it's a good cause. So that leads us right into, I think, the next set of questions here, which is we're talking about whole life specifically because we're investors, let's say, and that's what we're told
Mhm.
is the thing that is going to help us. It's another part of our portfolio that we should have. But before we get into the details around why that makes sense, what can you explain what the process of whole life insurance looks like? So just the insurance part, like how much do you have averages on how much it costs to sign up, how much I'm paying per month, what that kind of payout
Mhm.
is if I die to my family, just kind of that process from birth to end of the policy.
Yeah. I mean, it's fairly easy. I mean, I know for one, I guess you can kind of think of whole life or any type of permanent insurance plan that has cash value as like owning a home. It builds up equity over time, and you could use that money to, for whatever it is you may need. But flip side, which we'll get into it, is it's not taxed. But as far as the process goes, one, do your research and choose a life insurance company that's actually solvent, meaning choose a company that has higher assets than liabilities and can actually pay out future claims, because
Hmm.
there's tons of life insurance companies out there. And yes, you can find a policy somewhere, maybe they'll say, oh yeah, you can get it for $52 a day or $20 a day, all of that stuff. But you don't want to believe that, because if they're giving a cheap policy, that means it's probably a cheap company. And the worst thing that could happen is you pay for a policy for so long and then there's no payout. So do your research on the right company when to solve it. Secondly, talk to an agent that can determine the type of policy that actually fits you and your family's needs. Whether it's term insurance, which is a kind of temporary need, or if you want to take the leap to get some type of cash value policy, they can direct you in what policy, if they're doing their job right, what actually fits your needs once they kind of have like a discovery conversation on many assets you have and what you're actually looking for to make sure that your family is set up right. Um, Thirdly, you answer questions on the application that range from your gross annual income, medical questions, and personal history questions. Um, I mean, really, that can take less than 30 minutes if you're just kind of breezing through the application and answering the questions properly. And side note, if you're self-employed, I've noticed in my you know in my time of doing insurance that many self-employed people, um, life insurance is directly connected to your finances. So if you're a
Hmm.
business owner and you are out here not claiming that you make any money, during the year, that can actually hurt you, because life insurance is completely dependent on your income. So if they're looking at your income and you're saying you only make, $50,000 a year, but then you have 10 employees, it's kind of a red flag, and you may not get the amount of insurance that you want based off of what you're giving out. So heads up on that. But yeah, application process, 30 minutes or less. And then if necessary, fourth, take a health exam. And then once you're approved, you submit the payment and that activates the policy. I mean, it's simple as that.
Okay, so I'm gonna hopefully force you to break it down a smidgen more. When I go
Hmm.
in, let's say, and I apply, I'm gonna say I'm 35 ish.
Hmm.
That's a nice number to me, 35 ish. All right, so I go in as a 35-year-old, and I have no medical history of any problems. I've got a good, solid employment. Here in Silicon Valley, it's probably a tech job somewhere, and then
Right.
I sign on the dotted line. Is there an entry fee to start off with?
Yes. So there
Okay.
is a, initial down payment or whatever that amount comes out to. So I mean, if you're I mean, I can't really, throw out a number because it'll be
Sure.
incorrect, but I guess if we just had to, guess, you're 35 years old and you do I don't know, $100,000 life policy, maybe the quoted amount would be $150. But then
Mm.
if you have to do a health exam, um, once all that information comes back, as far as, getting your blood, quick urine sample, measuring your height and weight, it can actually be less than that. Like if you're in the best health of all, then I mean, it can easily be instead of $150, maybe $70 or 90. You know, it can drop based
Gotcha.
off your health. So that's the key:
Okay.
age
Is
and
that the
your
monthly
health
or the
status.
the initial start fee?
That's monthly. So
Okay.
most companies, I mean, they'll either have you pay a 2 month down payment because that's just maybe the way
Mm.
their billing system is, or in most cases you just pay that first month, then it's activated and you're covered from that point on.
Okay. So then, like you said, if it's $100,000 policy, and I sign on the line, if I were to die the next day, that $100,000 would go to my family or whoever the beneficiaries were.
Exactly.
Okay. So that's just the simple life insurance part. And assuming I keep paying that for the rest of my life, will that be the same number as I get older, or will it go up in price as get older?
Um, it depends on the policy. So
Mm.
if it's like a whole life policy,
Mm.
that number is stuck and it's stuck like that until you cancel it or you pass away.
Mm.
If it's a universal life, that's a bit different. It's a bit more, I guess you could say, variable. So that amount can change over time.
Gotcha. We like hearing about things being stuck because we've talked about inflation on this channel before. So if it's
Right.
stuck and things continue to inflate, we do like to hear that. All right.
Exactly.
So I think the life insurance part is pretty straightforward. To sum up that part, we have a fee or a down payment, or it could be just like first month's payment or first 2 months that we're putting in, and then we're going to pay monthly based off of health factors, age, and all of that, and then whatever the policy is that we choose. So it doesn't have to be $100,000, right? It could be higher or lower. Is there like
Right.
a cap or a minimum?
Yeah, depending on the company, I mean, there definitely is going to be a minimum,
Okay.
especially if it's like a whole life policy. I believe probably the minimum is like 75,000 around or 25,000 around there.
Okay.
And I know at least like with like farmers, for example, the cap is about a 250 grand for whole life, but with the universal policy, you can do more. You have a wider range on what coverage amount you want.
Gotcha. Okay. And then that payout, does it have to go to anything specific, or is it just go to the beneficiaries, like cash in their bank account?
I mean, it can go to a beneficiary, individual or multiple individuals, whether it's spouse, kids, friend, uncle, or it can actually go to the estate. So if you have
Okay.
like a trust set up, you can connect that trust as a beneficiary. So then that money goes directly to the estate.
Okay. Awesome. So I think that covers the insurance bit. So for someone who's a more hardcore investor, someone who's like invested and saved up quite a bit in things like real estate, index funds, etc., I've always thought I don't need life
Right.
insurance because my beneficiaries to all those plans, or the entire net worth that I am is going to go to my beneficiary to all those plans when I die. So,
Hmm.
hearing numbers like 100 and $200,000 when I die is really insignificant. So in my head, I think, why even worry about a policy if they're going to get so much more when I die anyways? I would rather put that money into investments and grow it over time in hopes that I don't die. You know what I mean? But
Right.
but not that they're not taken care of if I do. So the next
Hmm.
part is the cash value bit. Now, this
Hmm.
part confuses me a little bit, and a lot of wealthy people will use a whole life plan, and this is the part that they're interested in. They're not as interested in the life insurance. Not that they're going to turn away $200,000 or whatever the number,
Right.
but
Right.
they're interested in this cash value bit. Can you explain what that means a little bit more?
Yeah. Essentially, the cash value is just the amount that accumulates in the policy, um, which grows more and more given the premiums you pay into the policy, whether you pay, each month or each quarter or each year. So I guess you can kind of look at it like of course you have like that coverage amount. Let's say 250,000 that would go to your beneficiary once you pass. But then there's that cash value, which is like a pot of money that's within the policy that grows over time that you can use for anything. So kind of,
And that's
to
different
kind
than
of
the payout.
piggyback and well, the payout would be so let's say you have that $250,000 policy and you
Mhm.
have a cash value amount of I don't know $25,000. You haven't had the policy that long. Then once you pass, your beneficiary or your estate gets that death benefit of 250 plus the cash value that's in there.
Hmm. Okay, so it's added on top of. Okay, how does that accumulate?
Right. So each premium payment that you're making, um, a piece of that goes to, I mean, on the back end, your premiums payments are paying for like the cost of insurance that the insurance carrier has to pay for like servicing that policy. But then also a piece of that is also going into that cash value pot every time you pay. So that's how it
Hmm.
starts accumulating and growing.
Okay, so by cash value, does that mean that I can just take that money out at any time?
Yes. So
And how does that
that's
work?
the beauty of it, and that's why people that do understand money will see it as a benefit, is because although you may have that you know all those properties as far as real estate goes, you
Mhm.
have the 401k, you have your stock accounts, all that. I mean, realistically, if you pass away, all of that money is going to be taxed also. I mean, especially real estate. I mean, you have those capital gains taxes that you really can't get away from
Mm,
unless you do like you know, a 1035 exchange where you just
mhm.
plop that money
10,
into another
1031.
property, or 1031 exactly. So that's really the only time you can kind of get away from the tax portion of it. But with life insurance, the cash value is not taxed once you take it out. I mean, the
Mm.
only time that you actually have to pay, like maybe like a standard tax rate, is once you've had the policy for so long that now the cash value outweighs the premiums you put in. So you're actually like almost like profiting off of it. But that's like way far down the line.
Gotcha.
It takes a while to get to that point. But outside of that, you take the money out, you're not being taxed for taking it out. Like you don't have to report anything to the IRS.
Okay. Is there a negative to taking that cash value out?
Um, no, I mean, I guess the negative would be if you take out the cash value and maybe you take out too much at one time. Like let's
Mm.
say there's 15,000 in there and you decide to take out 14,000, and it's only 1,000 left. Then that's when it can kind of be a negative because you know there's interest attached to that money being taken out because it's essentially kind of like a loan, um, with about a 5% interest rate. If that's just sitting there as like outstanding loan balance, then the policy can kind of like implode because it doesn't have enough to sustain itself over time. So that's really the only negative. But
Well, I
if
want to
you
get to
have,
the loan stuff here in a bit,
mhm,
but you're,
mhm,
you're referring to taking the money out in terms of taking a loan against your policy, correct?
right, against that
So,
cash value
yeah,
amount.
I'm referring to just the cash value itself. Can I just take that cash straight
Uh,
out without taking a loan?
well, anytime that you're taking that cash out is considered a loan.
Ah, gotcha. So that basically stays there until I die. The only way to really get the cash out is through this loan process.
Right.
So the only time it comes out is at the end, or when I actually die, and then the policy is paid out. That actual cash comes out. That's not a loan.
Right. So if you have the policy, you never touch the cash value, then the payout is going to be whatever the coverage amount is, let's say 250 plus that cash value amount that's there. If you you know over the course of the policy have pulled some money out, then once you pass away and the money gets sent to the beneficiary, they just deduct whatever loan balance is present out of that entire amount, that lump
Gotcha.
sum.
Okay.
So it's not like the beneficiary has to pay off the loan amount before they can get the money from the life policy. They just say, "Oh, there's an outstanding loan balance of $3,000. Let's deduct that out of the 250 and then give them the rest."
Okay. So I have a few more questions on the cash value part, and then we'll jump into the loan bit here. Um,
Okay.
the next one is, as the cash value is sitting in this policy, is anything happening to it? Is it gaining interest?
Um, there necessarily isn't like interest attached to the cash value. I guess you can say that the cash value or the money that's accruing in the policy kind of like is the interest in the policy, if that makes sense. So like those premium payments that you're making each month or each quarter or each year are specifically being plopped into, or a portion of it's being plopped into that cash value, which I guess you can kind of look at as, accrued interest.
Okay, I see. So I'm putting money into an insurance policy. The insurance company, assuming they're obviously not paying out to insurance claims more than they're accepting in, they're taking that
Mhm.
money and investing it. Then whatever
Essentially.
interest they get off of that invested money, they're distributing back in terms of cash value into the policyholders. Did I get that about
Um,
right?
well, actually, yeah. So that's another piece of it. So there's actually two of those cash pots, depending on the type of policy you get. So there's just the cash value itself. We're speaking of where you can take that loan out on whatever amount that you need, and then there's something called paid up additions, and that's essentially like dividends that the insurance company is putting back into the policy for you. So it's almost like you have two cash value pots. I mean, you can choose to have
Mm,
it so, at the end of each year, they say, okay, we looked at your policy and you have an accrued, paid up additions or dividend amount of, you know, 3 grand. You can actually choose when you set up the policy to have that money sent to you in a check, but then at that point, that portion of it's actually considered like income, so you would
sure.
get taxed on that. But most of the time, me personally, doesn't make any sense to do it that way when you can just have it pretty much put back into the policy. It purchases extra insurance, and then if you needed to take it out, just similar to the cash value, you can do that with the paid up additions too. So in that way, you kind of stay away from like the tax side of it.
Okay. So the more I have in cash value in my policy, does that increase the amount of returns I'm getting?
Yeah, definitely, definitely.
What
Yeah,
does
the
that look
more the
like?
more premiums you pay into it, I mean, really, I guess the baseline is having a big enough coverage amount or death benefit amount that will give you a bigger amount of cash value. Because obviously, if you only have a cash value policy that has a coverage amount of 75,000, I mean, your cash value is going to be a few $100s or something like that every year, and as time goes on. So the bigger coverage amounts you have, the bigger the cash value pot will be, and that's kind of how it's accumulated because now you're putting in bigger premium payments, which is then giving you bigger cash value amounts put into the policy.
I guess my question is around like if let's say the cash value of my policy is it or is there an estimated percentage growth that I could predict off of the cash value, like yearly percentage growth? So if I have 10,000 and you predict like a 5% growth for a tenth, or oh man, I'm gonna have to do math here live. That's always risky. All right, so if I say I have a $10,000 policy and I can guesstimate, based off of like an annual return of 5%, the growth, then I would have $10,500 on a 5% growth, right? So could the next year I could assume 5% against that 10,500, like compounding interest?
um, I mean, if you wanted to apply an actual percentage, I would say it'd be safe to say maybe around 5%. Um,
Hmm.
I actually don't know the specific percentage growth because I know it's also based off of course, the premiums you pay, but also um, really the company's profits and all of that. I mean, because the only really I guess negative time is, or the thing that's kind of even listed on like an illustration, for example, is that there is a section that will say on there, if the company, essentially is insolvent, then there's a possibility that maybe the cash value cannot be what's actually illustrated. but
Mhm.
that literally hasn't happened since. I mean, as far as I know, with Farmers, New York Life, State Farm, um, all the big life insurance companies, it hasn't happened since they've been a company. So, not too much of a worry.
Gotcha. Okay. So to sum up real quick, and I want to get to the before we run out of time, I want to get to the debt bit. Um,
Mhm.
if I was to take a policy out, then I'm putting money into this policy. It has a death benefit and a cash value that gets returned to my family on death.
Mhm.
If I was to do nothing else but those two things, essentially it's just life insurance at that point, right? And the cash value is not something that I can collect, excluding the debt part, right? So if we don't do the debt part, it really is just we're purchasing life insurance, and the cash value is almost like a cherry on top that builds a little bit more in terms of payout. Does that sound about right?
Um, yeah, essentially, yeah.
Okay.
Because the end all is, yeah, is you're essentially getting a policy to make sure that once you pass, a lump sum of money gets sent to your family, so they can take care of everything that's left over after you leave. But yeah, the cherry on top is that, because everyone always thinks that, life insurance, death. I don't want to think about that. Some people even think if they get a life insurance policy, they're all of a sudden going to die. So it is kind of like a negative, correlation to it. But yeah, the cherry on top is that the cash value is something that you can actually use while you're living and benefit from it and leverage
Okay.
it.
And that's the next
So
bit, which is this debt part. So you can take out a loan against your policy.
yes, correct.
And how does that look?
Um, that is essentially just requesting, like, let's say, for example, I'm your agent and you're like, hey, you call me up, hey, Mark, you know, we kind of hit a snag in the finances. I know I have a good amount of cash value in the policy. I need to pull that, pull out 10 grand. Okay, I send you a, a paper that says essentially policy change or policy loan. List on there $10,000 needs to be pulled out of the policy. I sign it, you sign it electronically, do DocuSign, and then within 24 to 48 hours, you get money, depending on what way you want it, either sent by check in the mail, or it just could be direct deposited into your bank account. So I mean, there's no restrictions. It's not like you have to say on the paperwork, I need this money to pay for home renovations, or I need this money to pay for medical bills, or there's like no hardship or um, you know, you being penalized for taking it out. It's just I need the money, you take it out.
Okay. And from what I understand, so I was trying to get at this with the cash value bit, is that if your cash
Mhm.
value is growing in terms of, some sort of interest rate of growth per year, and I'm still a little bit fuzzy on that part, but maybe you can help out and explain this a little bit. But if that's growing at a
Mhm.
higher rate than what I'm actually putting in as a premium, and I go and take a loan out, essentially the interest rate of that loan would be covered by the growth of my policy. Does that sound about right?
Yeah, if there's enough cash value in the policy, then essentially yes. Hmm.
Okay. And do you have estimates on what kind of numbers that looks like? You said the 5% number is about right for the
Hmm.
policy, right? So if I take out a loan against the policy and its interest rate is 5% and the loan is, less than what I have as cash value, then that should about balance out.
Right, right. I mean, the number, the key to taking the cash value out of the policy is just not taking so much out where now the loan balance outweighs how much cash value you had. And I mean, there's going to be a loan or interest rate attached to any money that you pull out regardless. But of course, just like even in other finances, the more you take out, the more you're going to end up having to pay back. And I mean, the interest is going to, accrue on that bigger outstanding balance. But that's again where, if you're talking to a person that's knowledgeable, they'll direct you and say, hey, you have 20 grand in here. If you want to pull out a sizable amount, maybe we just pull out like 15 and not just the entire, thing. So that's kind of the way to do it, to get around the policy kind of like imploding and not being able to sustain itself.
Okay. Why would the policy implode if we got too low there? I mean, we're still paying our monthly
Um,
premiums, right?
right. So you're paying your monthly premiums, but let's say, that there is that 20,000 in cash value. You decide you want to take out 19,000. Um, the interest accrues on there, and once the interest um, is more than what's left in the cash value, it just is going to eat away at it. And at that point, the policy collapse because like,
Mm.
hey, there's an outstanding loan balance. Now, it was $1,000, but then the interest that is accrued is $2,000. So that like, you have to pay something into it to kind of get that to, be able to regulate itself. And if not, it will lapse. And that's kind of where um, buying the right policy and talking to the right person is super important, because I've seen, not to throw any shade, but like the Transamerica people,
Mm.
um, they'll tell you to go buy a universal life policy, and yeah, you put money into it, it grows, it accumulates, you're good for the rest of your life. And then people will buy those policies thinking that, not realizing that, it's a bit different from whole life, but there's more like fees associated with that particular policy. So if the fees are completely eating away at the policy already, and you have an outstanding loan balance, and the interest is higher than the cash value, then it literally will not stay active anymore. And I've seen
Mm.
people get into that scenario so much when all someone had to do is call the client up and say, hey, I noticed this, put in a little bit more money, and we'll make sure the policy doesn't cancel out.
And if the policy cancels out, I mean, it's essentially like everything you put in is gone at that point, right?
Right, right. Especially if you've taken all the cash value out. I mean,
Mm.
if there's anything left, you'll get that small chunk of change. But then the the downside is that if it cancels out for something like that, and let's say it's 15 years in, now you're 15 years older, and that same policy is going to be more just because you're 15 years older. I know people are. I mean, obviously, if you don't know what you don't know, so it could be kind of scary to think about doing anything that involves finances, and if you're going to lose your money or not, or if it's going to appreciate correctly or not. But I mean, life insurance is one of the main things, and especially since I've been in it 14 years. Um, it's like I've never heard anybody say, you get into a car accident and you're like, man, thank God I didn't have car insurance. Like, no one says that. you know it's something that when it's there, you appreciate it. But if you don't understand it, you get kind of scared and want to walk away from it. But especially in recessions, um, I mean, life insurance is one of those things that wealthy people will dump their money into, because they know that it's like a guaranteed um, appreciation of your money within that cash value amount. And again, you're not having to get taxed on it when you pull the money out. So it's perfect example. I mean, it was years ago, but
Uh-huh.
there
Go ahead
was
with your
someone.
example, and then I
Oh
have one
yeah,
more question here.
okay. Um, it was some years ago, but this is like the perfect example of how to use cash value life insurance. This woman was in her late 60s. She got a huge whole life policy when she was like in her 20s, because her, parents had life insurance. So they told her, like, get it when you're young. And when she was in her 60s, had a primary house out here, then a secondary home in Hawaii. And she had called up and said, hey, I need to pull out some money because we had some issues in the kitchen, and we just thought we're going to fix that issue, but also we kind of want to renovate the whole kitchen. The house is a
Mm.
little bit older, and we know that it would just be a little bit more, peaceful. We just made sure everything looked nicer because it's an older home. And I was like, okay, well, how much did you want to pull out? And she's like, well, she was a person that paid attention to her policy all the time. And she was like, I know we have like about 200 and something grand in there. So I think we'll pull out like 100,000. So that was the first time that I saw someone pull out that much money out of a life
Mm.
insurance policy. And again, sign the form. You say you want X amount of dollars out, signed by each party, and then they send the money. So the the key thing to that was that the money wasn't taxed. Like, yes, you have an outstanding loan balance on the policy, but you can pay that back whenever you need to. It's not like, oh, you have to pay this every single month. Um, and she was able to use $100,000 out of that policy and dump that into her house, which has completely appreciated in value, without having to go get any type of personal loan and go to the bank, or to do a GoFundMe account, or any of that. I mean, she had it easily accessible, and it was sent to her in 24 to 48 hours. And I was like, why don't people have this? You know,
Mm,
like that was the first time I was like, this is like a gold mine, especially if you have it set up like that where you can use it with, I mean, you're just dumping money into another financial instrument that's going to appreciate really. So it made the most sense to me. I was like, she made money on that money. If you look at
okay.
both ends of it.
Yeah, we do like that. We like leveraging to make money. We're
Right.
huge fans of that. Um,
Right.
my question was when you were talking was can I put more into this cash value than just the policy? Like if I wanted to add an extra
Um,
$1,000 this month, could I do that? And is there a cap on that?
well, with whole life, it's once the policy is issued and you're paying that 150 a month, that's it. That price
Hmm.
is stuck forever unless you decide that you want another whole life policy with more coverage. But the universal life, those are the ones that are more variable, and you can put in more if you choose to do so, and then that still equates to um, higher higher cash value amount within the policy. So yeah, the universal life policy is where you can do that.
Okay, we'll have to get you on to talk about universal life another time. Because this
Yeah,
is just the whole life conversation is already a pretty big thing to digest, I think.
yeah,
But
definitely.
let's see. Before I let you go, what are some pitfalls we should watch out for if we're signing up for a new
Um,
policy?
I would say the pitfalls, there's really not too much. I mean, one, of course, like I was mentioned earlier, the universal life is those are policies that need to be managed by you and the agent or life
Hmm.
insurance company because again you can get caught up in all the great benefits of the policy, which it does have great benefits, but you get so caught up in the positives that you're not paying attention to the negatives. And on another call, we'll definitely go over universal life, but that's the main one where I see a pitfall where you've been putting in $100 every month for the last 10 years, not realizing that now the quote unquote the account value has gone up since the 15 years, and that $100 is not keeping the policy in a good space. So then you
Hmm.
end up having the account value that eats away at the amount you're putting in. So that's something that easily an agent could just look at and say, hey, you've had this policy for 15 years, you're putting in $100, let's bump it up to $125 to make sure that it doesn't cancel in the next 5 or 10 years. And you just
Gotcha.
make one extra, $20 more payment, $25 more payment, and then you're fine. So that's one pitfall. I mean, outside of that, the only other pitfall as far as life insurance goes is really just missing a payment.
Hmm.
I mean, if you aren't paying attention to it and you miss a payment, especially when you've had a policy for so long and you miss that grace period window of like 30 days past your due date where you need to get the premium in, then once it lapses, you have to pretty much start over again. And if
Hmm.
it's been 15 years, again, you're 15 years older. So that price for that same life policy is going to be more just because of the age. And you can't really dictate what your health will be in that 15-year period. So if you ended up, having cancer, then that's a pretty big one that will get you denied. So, my key thing is get life insurance while you're young because that's when it's most affordable and when you're healthy. You don't want to wait until you're 63 years old and you start realizing like I'm knocking on death's door and now I think I want to get it, but you have all these crazy health conditions. I mean, it doesn't feel good to get denied when you want to
Yeah.
set something up for your family.
I hope I'm not knocking on death's door at 63. Man, let's go for a little longer than that. I gotta
Right,
slow down on the
right.
tacos though, if that's gonna be
Yeah,
the
me
case.
too.
All right. Well, thank you so much, Mark. I super appreciate you coming on and talking to us. I think we got a lot of questions answered for the viewers. If you have
Mhm.
questions, maybe you could comment down below and we'll get Mark back on and we'll ask him some of those questions. I think that would be awesome. And then we'll also have to get you on for Universal Life because I'm interested in finding out more about that. But before I let you go, do you have any way that people can find you?
For sure. I'm on Instagram and Facebook at the Hicks Agency. So TheHicks Agency. IG and Facebook, and of course My office is in San Jose, California, but I can help folks in the entire state of California. So
All right.
feel free to call me at 408-445-9700.
All right. We'll add that to the description too, so that if you didn't write that down, it'll be easy to click on a link. And yeah, that about wraps us up. Thanks, Mark. Appreciate it.
No, thank you. I appreciate the time.
All right. Thank you for viewing, people. If you liked what you saw, please like and subscribe. That helps us out tremendously. And until next time, thanks for stopping by.